One wrong move in investing can wipe out your life savings, turning dreams into disasters. From the 1929 crash to modern Ponzi schemes, history's littered with avoidable mistakes that cost billions. Today, we're exposing 7 deadly investment mistakes to avoid through untold stories of Wall Street's biggest blunders. Learn these and protect your wealth. Don't be the next victim. Let's dodge the pitfalls. Welcome to my channel, where we uncover the stories behind money and wealth, like Histophone's deep dives. We LLU's real tales from Jesse Livermore's ruin to Enron's collapse to spotlight errors beginners and pros make. We're covering chasing trends, emotional trades, no diversification, skipping homework, over-leveraging, ignoring fees, and holding losers. These aren't just warnings. They're your shield to smarter investing. Hit like if you've dodged a bullet, subscribe for more, and let's save your portfolio. Mistake 1. Chasing hot trends, jumping on fads without research, driven by FOMO. The story? The 2000 dot-com bubble. Investors poured $5 trillion into internet startups like Pets.com, hyped as the future. A sock puppet ad went viral. Stocks soared 300%, then crashed 99% in months. Why? No profits, just buzz. Folks like day trader Joe from suburbia lost homes betting on the next Amazon without checking earnings. The sub-pitfall is FOMO buying at peak, seeing CNBC hype. You pile in late. Or ignoring fundamentals. Pets.com burned cash on ads, not its business. Billions evaporated when reality hit. Avoid it by waiting for proven models. Use tools like Seeking Alpha to vet trends. Ask, is this sustainable? Stick to 5 to 10% of your portfolio in hot sectors. History shows trends fade, value endures. Don't chase. Research. Mistake 2. Emotional trading, letting fear or greed hijack logic. Take the 2008 financial crisis. As housing bubbled, then burst, stocks tanked 50%. Panicked investors like retiree Sarah sold her diversified fund at the bottom, locking in 40% losses, while the market has rebounded 400% since greed fueled the bubble. Banks like Lehman overlent, holding toxic assets for too long. CEO Dick Fold ignored warnings, leading to bankruptcy and $600 billion in global fallout. The sub-issues are panic selling in dips, where fear sells low, or greed holding winners that peak. Like the Bitcoin crash in 2021, emotions blind you to data. Dodge it by setting rules upfront. Rebalance. Annually, use stop limits at a 10% loss. Journal your emotions before a trade. As Buffett says, be fearful when others are greedy. Automate with robo-advisors like Betterment to stay rational. Emotions cost. Discipline wins. Mistake 3. Ignoring diversification, putting all your eggs in one basket. Remember Enron's 2001 scandal. Employees like accountant Ken had 60% of their 401ks in Enron stock, which was touted as safe. Executives hid debt with tricks, and the stock plunged from $90 to pennies, wiping out $74 billion and ruining 20,000 lives. Ken lost everything, while diversified folks survived. Sector bias made it worse. Energy hype blinded everyone to the risks. Sub-traps include overconcentration in one stock, like Tesla fans going Elon, or one sector, like tech during bubbles. One bad event tanks you. The fix is to spread across 10 to 20 asset stocks, bonds, ETFs, using a 60-40 split. For example, use something like Vanguard's VT for a global mix. The rule is no more than 5% in one holding. Diversification isn't exciting, but it's your safety net. Enron proves one basket breaks dreams. Mistake 4. Not doing your homework, skipping due diligence for sure things. Think of Bernie Madoff's $65 billion Ponzi scheme. From the 1990s, he promised steady 10 to 12% returns to elites like Steven Spielberg. Investors like retiree Elaine trusted his reputation without checking the audits were fake. The returns impossible. When it was exposed in 2008, it devastated 37,000 victims, and suicides followed. Blind trust in gurus or ads ignored red flags like no risk. The subrus are falling for scams like crypto rug pulls or unverified tips from social media pumps. No homework means no protection. To counter this, always verify 10Ks on Edgar. Check SEC filings. Use Morningstar for ratings and diversify your sources. Start small and maybe paper trade on Thinkorswim. Madoff's lesson is, if it sounds too good, dig deeper. Knowledge is your best defense. Let's do a quick recap of the full 7 deadly mistakes. 1. Chasing trends. Wait. Don't FOMO. 2. Emotional trades. Use rules over feelings. 3. No diversification. Spread the risk. 4. Skipping homework. Verify everything. 5. Over-leveraging like margin debt in 1929. Avoid borrowing to invest. 6. Ignoring fees. A 1% fee eats 28% of your returns over 30 years, so choose low-cost index funds. And 7. Holding losers forever. Cut them at a 7 to 10% loss, as Livermore advised. These blunders cost trillions, but avoiding them builds empires. Start with education. Books like The Psychology of Money. Use apps wisely and consult advisors. In our niche, stories show that mistakes teach more than wins. Turn pitfalls into profits. Avoided a mistake today? Like this video, subscribe for more Wealth Guardians, and comment below. What's your biggest investing fear? Share to save a friend. Next up, we've got more untold tales. Invest smart. Your future will thank you.